So I will, take what I see coming, the advantages I might see in the marketplace, some of the loopholes or beneficial strategies. And because I have exposure to, various commercial and residential, short-term rental, long-term rentals, development projects, I can get a feel for what I think is what's working. And at that window of time, that's what I'll focus on. And I like to pair investments together to diversify.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Mike Cossette. Mike is a world traveler and a REMAX broker owner in Central Texas. He has 20 years as an agent investor who owns and manages multifamily, short-term rentals, commercial assets, a Florida island, and recently has had 4 kids in less than 4.5 years. And in just a minute, we're going to speak with Mike Cossette about long-term success with market volatility. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Mike Cossette. Welcome to CREPN Radio.
Thank you, Darren. I appreciate it. Thanks for having me.
Well, I'm glad you're here, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, absolutely. So, in and out of a couple marriages and found the woman of my dreams, traveled the world. And then we got, when that gets tiring, then you got to figure out, okay, what's the next step? So then we decided, okay, we're going to settle down and we're going to have some kids. And we took a lot of the travel experience that we had and a lot of the crazy trips and death-defying things that we went through and decided, man, we really got to go all in, and because life is short, and we realized that. So when that happened, we got married, and then we went all in on I went all in on real estate. I was already in the real estate game, but I really decided I wanted to get in the investing side. So we started building stuff, buying stuff, investing in stuff, and having kids, lots of kids in a short period of time. So the last 4 or 5 years has been a crazy whirlwind, picked up a lot of properties and children. So, that's kind of the truncated 10-year version.
That's awesome, man. The kids alone, I mean, 4 kids in 4.5 years, a lot of people would stop there. But
Yeah.
that's to do all the real estate, and that sounds like you got a special lady there. That's awesome.
Well, let me tell you, the kid situation, surprise twins for me. And so that's how the math works there. I know a lot of people, how is that even possible? Well, we had 2 boys, that was great. And then boom, twins after we had just been picking up real estate assets and self-managing them, then that happened. So that's how it all came together. It wasn't pre-planned necessarily.
That's awesome. Well, congrats to you. That's quite a handful. Well, let's talk a little bit about your real estate history here and kind of your path. You said you made the decision to invest. Prior to that, were you active as an agent or a broker?
Absolutely. I was active as an agent for 2005 to 2011, then got my brokerage license as the market started coming back around. And I was dabbling on the investing side. So that's kind of how I got into real estate, was through a college investment that I kind of rented out to fraternity brothers. It was able to pay for itself. We remodeled it, and it really struck me how the bank would relend more money on an asset that me and my fraternity brothers virtually destroyed. And that's kind of when the light clicked of, man, other people paid for this and we destroyed it. And the bank wants to give me more money. Like, how is this even possible? So from that point on, I got into real estate, and the investment mindset was built in kind of from that experience. But I really didn't really start focusing more on the investing side until we got through traveling in the marriage and stuff, and really understood that life is short, and if that's what I want to do, I got to do it, because you never know when it's over.
Um, well, what an exciting baptism into real estate there to have a place with your fraternity brothers, and then find out you can get more money to fix it back
Right?
up.
Isn't that great?
That's awesome. Beer money never ends. Uh, so you had the one you were in sales, and it sounds like kind of the market cycle. You'd the '05 to what was it, 11.
Yep.
That was kind of the great um,
The Great Recession.
recession. Yeah, I mean, kind of losing track between that and COVID
Oh, I know
and
it.
all that. But that really was an interesting time, because right to the run up, nobody saw anything coming, and then all of a sudden the big correction there. Tell me a little bit about your experience in that time, as far as the what you were selling, you know what were you seeing, and how did your I guess how did your view of the market, what was your experience as we came out of that into like I said, 11, when you became a broker?
Well, it was a wild ride. You were there. If you were part of it, and it was a shocker. I came out of college and 2004, 2005, got into the business, and things were just flowing. And fresh out of college, I'm used to very little stipend type money, little side hustles and stuff like that. And then I stepped into real estate, and one of my good buddies was a mortgage broker. So he literally called me, and this is my first full year in the business. He called me and said, "Hey, I can literally lend anybody anything. Just have them call me, have them tell me a number that they make, and we can lend them money." And I had no idea. I thought this was normal. I thought that was the name of the game. Like, oh my gosh, like I just stepped into a gold mine. So that year I made more money than it was only like 80 grand, but out of college in 2005, that was massive. And didn't really understand the tax side of things. But then 2006 and 2007 were pretty good. And 2008, the other shoe fell off. And then that began to really understand that that is not the normalcy, and that this is a grind. And so we actually trimmed down our brokerage. We got down to, and started getting into bank owned assets like everyone else, or like a lot of people. Really dove into short sales and understanding how the short sale game worked back with fax machines, when you had to fax 100 documents, trying to prove that this person could sell below the mortgage that they owed. And so we got really good at that, and that ran for about 2-3 years, really. Yeah, 3 solid years, where there was years where the only properties I was able to sell were ones that I bought just because I knew there was an opportunity, and they were rewriting the mortgage laws literally backwards. And so there were the gaps in the mortgage regulations that could be kind of exploited a little bit, that you can't do now. That at that time we were able to use some of those loopholes that were forming to purchase stuff from ourselves through our companies. That seems crazy now to think about how that was possible. But then coming into a market that started taking off, and really we felt it in Central Texas, was 2013 was the first year where I really started saying, okay, people are actually starting to call me and come to me and actually be able to do stuff, have money, buy stuff, sell stuff. And so that started out the next, really what 10-year run, 9-10 years, all the way to COVID, and then it kind of reset everything again. This last 2 years has, for a different reason, really brought me back to that early, at that time I think I was in my late 20s, grind of having to put in the hard work that the last 7 years, really didn't have to do. So going through that, I definitely learned a lot. And I think everyone that went through that now is really having to get back to their bases. And a lot of people, that new agents and new brokers, everyone in the business, they're not really used to that. Those are the people that are really struggling and having a tough time right now. And, and I think that's where a lot of coaching and mentorship really can come into play.
Yeah. So when you first got in, living was easy. I mean, the market, and I think one of the things I want to ask you is, I mean, it seems to me like the availability of capital is pretty much what makes or breaks a real estate market. Do you agree?
100%, especially when you're talking about big assets and big markets, major markets, and institutional size assets. The capital structure and the availability of not only private money but institutional bank money, and being able to combine those in a structure that really works, is the foundation of moving that money and being able to kind of transact some of these big buildings and warehouses and other assets.
So when you were newly into real estate and you were, money was kind of fast and loose and everybody, like your broker friend said, anybody just tell me a number, we'll make it work kind of thing. Then we had the reset in the big correction there, the Great Recession or whatever we're calling that. So i- as things were transitioning and short sales became kind of the uh, the focus there, how was capital available? Were banks lending to the buyers, or was it creative financing to get through that, or how was that?
That was it was tough. So there was a period, and I would want to say maybe beginning of 2008, where banks were just going down, and they were just, the news, Lehman Brothers. I mean, it was just and it was almost impossible to get money from the big institutions. And at that point in my career, I had not experienced, or I had not really gotten into the private equity side, or the raising of capital outside of the big banks, the Fannies, the Freddies. So I can't really speak to what the private side was doing at that time, because I really wasn't privy to that until probably this last 8 to 10 years.
Got it. So in that cycle though, did you start out primarily as a residential broker or
Sure, and I still
okay,
am a residential
okay,
broker. So,
okay,
I like to lean more of my time into the investment side, but I
okay,
was definitely a residential broker, and I still am. I do commercial stuff that makes sense, that obviously with the kids, that I have the bandwidth to do.
okay, gotcha. And then as far as your investing goes, is there a particular asset class you focus on?
So not when it comes to myself, not specifically. So I'm more of an adaptive market buyer, investor. So I will, take what I see coming, the advantages I might see in the marketplace, some of the loopholes or beneficial strategies. And because I have exposure to, various commercial and residential, short-term rental, long-term rentals, development projects, I can get a feel for what I think is what's working. And at that window of time, that's what I'll focus on. And I like to pair investments together to diversify. So for an example, I like to say take a debt asset, or what I call a debt asset, and pair it with like an income asset. So in 2020, I bought a uh, income short-term rental out in off the coast of Florida, and also purchased a riverfront lot. And so together, we've got uh, a little bit of both worlds, and some tax advantages because the income can, right, basically pay for the land, and I don't have to pay taxes on any of it. All of it's appreciating, going up in value, and it kind of works out as a wash. And now I've got two assets that are being paid for by themselves, and I don't have to pay taxes on any income. So that's like one example of a what I call pairing type of deal. And uh, we also bought an island, like you mentioned, off the coast of Florida, and a multifamily property. And that was within a year of each other. So those aren't necessarily paired because we like to keep our multifamily segregated on its own for, financial purposes and that sort of thing. But between short-term rentals and long-term rentals, we would invest in those as well. I developed a short-term rental right around between 2013 or 20, I think 2013 is when we started doing the short-term rental thing, right when Airbnb started, and really saw growth there. So we started getting into the short-term rental side of things and even developed some, turned single-family houses into duplexes, and really took advantage of that window of opportunity. That window has kind of closed a little bit over the last 3 or 4 years. So we're not diving into short-term rentals anymore. So that's kind of the way we invest. I don't like to pigeonhole myself, even though some people say, hey, you find your niche, you go hard and you zoom in, and that's how you can get really good at investing in one thing. I believe that is true too. But for me, I like to play the markets and see what's out there. And I like having fun with new things.
Yeah, I think there's room for either strategy. I know people that have done well in both instances. My question to you, being somebody that's kind of more of an opportunist from a standpoint of, not a particular lane, uh, what is it that you look for when you're, going into a new um, an asset class or a new investment that you recognize as this has potential, or this is going to work? Are you drawing on your past experience? Are you learning something new and kind of realizing the upside? Let me know a little bit more about how you're recognizing these opportunities.
That's a great question. And I don't think that there is necessarily I'm searching in my head of all the decisions to try and draw a common thread between them. And the only thing that I can really kind of come up with is a maybe a slight market advantage or a market edge that I personally would have over the rest of the marketplace for that specific, not necessarily asset class, but that specific asset, from the location to the how it works, to the financial environment, and all of the pieces together. Where if any Joe Schmo saw this, it may not work for him that way, but because of the moving parts that I have in my life, I see an edge that could make that work better than trying to compete in something that on a level playing field with everyone else.
Yeah. No, if you recognize something, and whether it be your experience or your contacts or your local knowledge or whatever it is that gives you confirmation, this is going to work. And more power to you. Um, I'm kind of
And
curious that the island in Florida. I got to know what it was that you saw or thought, or what's your strategy with that?
I'm glad you asked that because I was about to jump in and interrupt you and tell and say, and sometimes, a lot of times it's a gut feeling. Like, it's just, hey, this just feels right. The yellow brick road is leading me there, and I'm not gonna shut the door on when it's wide open to something that's just fun and exciting. And the island would be an exact case of how we bought that in April of 2020. So the markets had everything had just shut down because of COVID in March. And so we were within the 60-day window of COVID hitting. And so I'm sitting in my house, and I had a actually buddy of mine that I went to college with. I hadn't talked to in about 10 years. Call me, and he needed to come to Austin to do some sales stuff. And he stayed at my Airbnb at our duplex. And so he's literally staying next door for a couple of nights. And I was explaining to him different market opportunities and stuff. And the next morning he came over and said, "Hey man, I want to buy an island." And it blew my mind. I was like, "What are you talking about? You are crazy." And because I was talking to him about how you could take a piece of land and literally rent it out to campers on a thing called Hip Camp. And then you can use that money and the business model as proof of concept to borrow against it and slowly develop an island or a piece of land, and not specifically an island. And then he came to me and said, "That's what I want to do. Buy this, rent it out to campers, take the money, reinvest it, borrow more, and rinse, wash, and repeat." And I said, "Okay, I've never bought an island before. I live in Texas, so let's do this." So I went and went through and figured it out. We secured the island under contract. And I told my wife, I was like, "You know what? I know he doesn't have enough money because we had to buy cash. Nobody's landing on islands." Especially undeveloped ones. So, and I said he's going to call me and he's going to ask me if I want to go in on this. And he's a little bit of out there kind of guy, like some crazy stories. And so I was like, I don't know, and if I want to get into business with him or not, but I know he's going to ask me that. And so, sure enough, just that day, he calls me and says, "Hey man, you want to help me go in on this island?" And so I said, "Man, I don't know. Let me get back with you." So I had another buddy that lived in Florida, just moved to Florida from San Francisco, and he had just bought a house, and he gotten like a big check from a moving company because they really messed up all his stuff. He was telling me about it. I said, "Hey, you know what? Do you want to invest that into an island?" And he's like, "What?" I said, "Yeah, my buddy Adam lives down there. He wants me to go in, but I don't know if I trust him a bunch, but I know he won't do wrong by you because he doesn't know you. And if anything happens, you can drive down there and go to the island and check it out. What do you think?" And he was like, "Man, I'm in." So us three together went in and bought this island. And yeah, and then the plan, we all have little kids, we all have our own businesses. And so the plan was to develop it, and it still is. We're still, it's only about in 1.5 acres and 1.2 acres above water, and it's comprised of two little islands that are connected by some mangroves. So we're in the process of developing it, but running into crazy logistical issues and environmental issues. The City of Florida Environmental Protection Agency, all these everyone wants a piece of the pie, as you can imagine. So what we thought was a slam dunk deal as an amazing development is now turning into be a massive puzzle that's going to take decades to figure out, but it's fun.
So has it been a camp? Have you been able to run it as a campground?
Well, so they're not quite yet. So we have camped out there, and people
Okay.
do camp out there, but we haven't been able to monetize it really. And obviously, the last 3 years, I don't know if anyone pays attention to Florida. There's been four massive hurricanes, and it's right on the Gulf Coast. So four massive hurricanes have hit that place area in the last uh, within a year time frame. And we have that short-term rental there too that we actually bought as a piece of to help facilitate the logistics of getting back and forth to the island. And that's been wiped out. And every time we get something going on the island, a little bit of structure. Everything's got to be solar. We got to have watershed. We got to have Uh, the septic is a whole nother situation, but the clean water, rainwater collection, there's no way to, so all of that infrastructure, as we start getting pieces together, just gets wiped out by hurricane. And it's just like, so we're trying to be as, figure out how we can structure it. And right now we're thinking underground with, everything's buried and people come out there, they pop up the tents and put the campsites together. And when they leave, they put everything back in a box under the ground. That's one of the ideas. So it's fun, but yeah, we haven't figured it out quite yet.
All right. So you got that. That one sounds like that's on the fun side and potential big upside, but not the right now. So
Right.
as you back up though, you've got these other investments, multifamily, short-term rentals, commercial assets. Tell me a little bit about, what the mix looks like and like what it was that you were drawn to or the acquisition strategy.
Sure, sure. So we've got a couple acres on a river that was long-term rentals. There are a couple houses. We've recently flipped them over to short-term the last 2 years, and now this year we're thinking about. And when I say we, I mean and about 60-70% of the stuff that I'm invested in, my dad, who's kind of retired right now, also will invest in. So that's for those that he's, I mean, we've got those two properties that we're playing with, but they started out as a client who needed to sell, and we couldn't sell that property. And it was an amazing asset, 6 acres, two houses on a river, and it's self-sustainable. It's got, so you could literally get off the grid, and it's, close to the city. So that was an asset that we just figured out we had to buy that because we couldn't sell it, and we had an market advantage there from the commission side of things. And it was that was at the end of that last crash, and so that's how we got into that one. And it's been great, and that's probably one of my favorite properties because there's so much diversity available for that property. And then we've got another little house that's downtown central Austin that I bought back in 2011 and turned that into a duplex when I found out we were having kids. Built a new house next door to it, rented out the old side so we could travel, and then figured out, wow, this is making money. Then we went to the banks. The banks were like, hey, these homegrown Excel sheets are not going to get you money. And finally, there was a bank that would lend, said, "You're a genius. We're going to lend you money." They did, so we built that, and now, since having the twins, we had to turn both of those into short-term rentals. That's doing really well right now, and then we have the multifamily, which kind of was a 1031 exchange type deal where it was just a single family rental. And we decided, hey, there's a lot of equity here. Let's roll it up and buy something that's more stable that we can start, building this, consolidating and getting cash flow. And so it's 12-unit apartment complex. So right now that one was seemed like a slam dunk move in 2022. And now, 2 years later, as you've seen and the market has seen, especially in the Central Texas area, we've got insurance costs have really gone through the roof. We've got the lending environment, the capital is so expensive right now, and the rentals rates have really kind of come down quite a bit. So it's kind of a perfect storm for multifamily that at one point, that was our support. That was what was keeping us afloat when the short-term rentals started suffering. And now that's kind of flip-flop where the short-term rentals are helping us keep the apartment complex, kind of afloat. So that's one of the things where the diversification really helps, because had we bought all multifamily, we'd be cooked. And, 2 years ago, all short-term rentals, same thing.
Yeah, no, I think that's the beauty of the multiple asset classes. If one's down, another one's up, you can still keep everything together, kind of thing, as opposed to pulling your hair out and trying to find the exit. And on these properties, I know you mentioned on the island you had your partners on that. On the others, are you invested with partners, or is it you and your spouse, or how are you set up on your other investments?
Yeah, so there's a handful that I own outright, and with my spouse, uh, and and then various ones I don't really have anything that has other than the island has two other partners, and outside of that, it's just me and another partner, or just me and my family, or me myself. I've got a builder that we actually just got into doing fix and flips at on the downside of a market, which has kind of bit us in the butt. And he was a partner in that. And what thought was going to be a 3 month fix and flip has now turned into a more of a Burr strategy where he's actually living in it. And we've refinanced it twice, hard money, private money, and now long-term debt. And we're about to put that one back on the market. So that was, a one-to-one partnership. And so there's a variety of structures depending on the asset class. I do have a great private money lender that really trusts me, I owe my financial, stability to, because he lets me to continue, borrowing money where we need it. And so that's been very helpful. And then, we have the institutional money, and we have good relationships with short-term hard money lending. So, you know, depending on the asset, obviously, we kind of like to play with all three of those levers and kind of build our capital stack that way.
Got it. So the flips you mentioned, those are kind of or at least a strategy by definition is kind of a short-term buy fix sell.
Yep.
Sounds like you mentioned that one's kind of become a burr, but you're planning to sell that. Are the other assets, are they long-term holds, or are you actively marketing any of those to sell, or what is it when you acquire a property, do you have a specific strategy, or is it again kind of a feel, see what's going on?
Well, short answer to that is both. So
Okay.
yes, I go into the asset class with a predefined plan. I underwrite it. I have plan B and hopefully, I can build in a plan C. Now, Mike Tyson said everyone's got a game plan till you get in the ring and get hit in the mouth, and then everything changes. So, and that's one of the things that we're dealing with right now is, you know, the over leveraging and the fast buying and investing over the last 3 years, and then now hitting with a perfect storm of all the things I mentioned: high expenses, declining rents, expensive capital, where you know everything's on the market. If there's a price for everything, so we're not putting everything specifically like in the Crexy or CoStar or MLS. Some of them we are, but other ones we are, marketing to various people that may have interest. And so there's not really right now anything that we're like, hey, this is an asset that we have to keep for good. There's ones we like better than others, but at any point we're ready to sell any of them. And some of the plans are still, like the apartment complex, for instance, that was supposed to be kind of a 3 year value add, stabilize, and then roll it up to a bigger complex. Well, now we're looking at a 5 to 7 year value add and situation, kind of like the fix and flip that is now a year and almost a year and a half that has turned into what basically is a burr now. So we're flexible, and there's no strategy that's not up for change.
Got it. And so do you have enough runway on all of your investments to where you can wait out the current market?
We're getting there. I think so. I think so. So one of the big challenges that I had was these Florida hurricanes. Getting hit by Helene and Debbie back in 2023. and then not having any income come in for a year, and then having really to come out of pocket for rehabbing it, and then getting hit again by Milton and Helene uh, this year, 2024. Now, that was 6 figures of out of pocket expenses that I was not planned for. So that really has been one of the things that you really just can't, those black swan events that you really just can't plan for, but you need to figure, my number one advice would be, hey, imagine all the crazy things and then add 20% to your CapEx or uh, uh, savings or contingency account, because when it rains, it pours. And so sometimes you just can't predict those things. So I think at this point, we are awaiting a big insurance check that is going to reimburse me, Peter, Paul, John, Jake, and Isaac from the borrowing spree that we've been on for the last year, trying to keep everything above water while we've been trying to rehab this property. So everything's you know uh, virtually going to be kind of reset here in the next month or so. And if that happens, then yes, we do have enough runway. If something, if you got a good word with Selective Insurance there, Darren, I'd love to.
Wish I could help. Yeah. No, I wish you well with that. I know insurance companies and waiting on checks and stuff. And hey, so specific to the insurance, did you have a property that was damaged by, was it a hurricane or what was
Yeah,
what was?
yeah, yeah. We
Okay.
had four hurricanes, and really Milton and Helene in Florida, Gulf Coast, right there between Cedar Key and Crystal River. Um, got hit by both really badly and completely wiped out. So that was the one that, luckily, after we got hit with Irene last year, we got a very good insurance policy, borrowed money from the SBA, and they required us to have a stacked insurance policy. And then when we got hit again, now we're able to make a solid claim. Had kept all the receipts, went through it before. So, you know, thankfully, we have that in place. But yeah, that's the property that got hit. And then the island, which has very little infrastructure, but everything that we had there is gone. Looks like the
Yeah.
gods went bowling on it when you look at the trees.
Yeah. And I think Florida is kind of a unique place, but it's always been that way. And I think, as cycles go, people kind of forget that. I mean, it's human nature. Uh,
Sure.
if it hit me yesterday, I'll remember it today. But if it hit me a week ago, maybe not so much. A month ago, not, a year ago, 2 years, 3 years ago, maybe not so much. Kind of forget about that. But it's always a potential, and Florida certainly flexing its hurricane muscle right now, which not necessarily a good thing if you're an investor down there.
Sure.
Um,
I think it's
so
a better situation in California, though. I have
yeah,
to say
no, I would
that.
say that again, the Santa Ana winds and the fires. I mean, as an insurance broker, I know we have struggled to place coverage for our clients with California properties for the last couple of years because the companies have been pulling out because they've been fearing this type of an event.
Wow.
And
Can I not pick your brain? I hate that saying when people ask me
yeah,
that, but can I ask you, from your point of view as an insurance broker, uh, understanding what's happening in Florida and California, what are, if you're the carrier, you know, what are some of the challenges and things that are the same and different about those two situations? Because from my point of view, it would be very difficult from an insurance, to decipher. I don't know. I'd love to hear your thoughts.
well, I think, and this has been something that I've come to understand more myself recently, is that I think that growing up, I think that we're all kind of led to believe certain things, and one of which was insurance companies. They take that premium and it's in reserve or it's an investment. It's invested to where they can pay out. They have the money available for when they need to pay out big claims. That was kind of always the way I believe things worked. What I've since come to believe and recognize is that the policy you buy is a 1-year contract. And it says for this amount of money, we'll pay you if these certain things happen, right? The the reality is that if you have a claim, there's not an instant check. They don't just show up at the site and say, "Holy crap, this happened. Here's your money," right?
Yeah.
Uh, there's a process, and it's a slow process. And so you have a claim, and especially if it's catastrophic, like in a hurricane or big wildfires, you're not the one guy that had the fire, the kitchen fire, right? This is everybody has needs. So the process is it's not a direct incident, adjuster, check, build back, you're done. It's not instant. It's very slow, it's methodical, and the slower it goes, it's the better for the insurance company because that allows them to recognize, okay, holy crap, we've got big losses, and their finances reflect incurred, uh, like what they know they owe, and then there's also incurred but not yet reported. So there's all sorts of forecasting goes with what their expected expenses are based on what their past incidents have been, right? So if they incur the loss in 24, they may not actually pay out on it until 25 or even 26, right? Fully. I mean, they'll give you partial payments because you need something in their contract says, well, we will give you an actual cash value settlement. That's what the contract says. Once you rebuild, we'll give you whatever else is owed, but you have to rebuild first before we give you that balance. So that's the cushion that they have built into the contract. Okay. Now, that's the aha that I've come away with here recently. On top of that, though, let me back up and just give you the market overview. So you have the brand of insurance that you buy that you know the name of, right? Traveler, Selective, whatever that brand is. Those companies actually buy insurance on the risk that they've taken on, and that's called reinsurance. So if you have a $1 million property and they've insured it for $1 million, they may take 100,000 or up to maybe say $500,000 in-house, right? They buy the balance of what they've agreed to, they buy insurance on. That's called reinsurance. The reinsurance market is really the one that drives the market. Okay.
Ah,
And if you understand that most claims are not policy maximum limits, most claims are smaller, right? That's
right.
why the whole thing works. So you have $1 million policy, you had a tree fall on the roof, you got, a roof and you're 20,000, whatever it is, kind of a claim, right? And you got a $5,000 deductible. So the company's out 15,000, you're out 5,000, you paid your $15,000 in premium, so it's almost a net zero for them. But the reinsurance company's never even heard about it.
Right.
When you go into these hurricane cycles or these wildfires, the policy limits are in play, which means the reinsurance companies are getting hit. And whether or not you believe in global warming or, I don't want to get into that, but I'll tell you what, the insurance companies believe in it because they're paying the claims. And as the atmosphere does warm up, the storms are allowed to get bigger. They pack more punch. They can hold more water. You see all the flooding that's occurring, right? Um, and the bigger, more frequent storms is problematic for insurance companies because how can they, if their model has been running for a very infrequent storm, smaller in size, scale, and all of a sudden they're faced with like bigger, more frequent scale, how do they, collect enough premium to pay their obligations? And the reinsurance companies set the rates every year. So around the first of the year, there's a big, meeting or whatever that they say, okay, we'll take on this much risk but we're going to raise our price. So that gets, um,
Took
communicated,
down.
yeah, communicates to the insurance company, then that then resets the rates for the buyer. the reinsurance companies are also saying, hey, look, we're cool with this, but we're no longer going to write this. It could be properties in California that are subject to wildfire. It could be properties in Florida that are subject to hurricanes. It could be wood frame Mexican restaurants without fire suppression. Okay, that literally, or it
Got
could
a
be
little experience with that.
yeah, or it could be older apartment buildings that are not sprinkled. Okay, all of these things they can selectively, and you have to remember too is that what we are facing right now is that the computers have so much data in them, and there are computer scientists that are mining the data to determine exactly, where is it that this is a problem, right? And the more they're able to do that, the more the insurance companies are able to be more uh, exact and cutting and, dance to try and avoid, what it is that they feel like is too big of a risk.
Mm.
And so anyway, it's a lot, a lot of insurance talk there, but the bottom line is that the reinsurance companies are getting hit hard. They're resetting the rates, and in some cases, the reinsurance companies are not even agreeing to continue. They're saying, "No, we're going to sit this one out." So the market then, where you and I are buying insurance, we're getting our bill and saying, "Holy crap, this is a lot of money. Why did it go up so much?" So we either call our agent, or maybe we don't call our agent, maybe we call everybody else trying to find a better price, right? Well, every other underwriter is, if they're used to having 10 applications on their desk to look at, now they have 100 and 150 applications on their desk because everybody's shopping, right? So
Yep.
now they're even being more selective. They're going, Mike, this one maybe. Darren, no, whoa, 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 no, 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 we don't want Darren at all. But then they find something that's brand new. It's got all the protection. It doesn't present as a potential risk. They're going to take that one. Okay. But so then what happens is all the people that are being turned down or whatever, they're having to go to the excess and surplus lines market, which is basically Lloyd's and all that. And they're all higher price markets. So it's a supply and demand thing. The hope is that the market gets healthy enough here in the near term to where companies that have raised their rates and stayed in the market start showing a profit, which will sound the horn to the companies that have been out, say, holy crap, they're making money now. Let's get back in. And as they get in, what you'll see is some price erosion in, some of the easier to insure situations, not necessarily across the board, because I think they'll still hold tight to their underwriting standards. But that's kind of we talked about all these cycles. We've been talking about investing. That's the insurance cycle. And
Wow. No, thank you for that. That was,
you know,
I know for
you
me
asked what time it
personally,
is. I told you how to build a clock, but that's that's kind of the
hey,
answer.
I just aha, I had a couple ahas and really can understand a little bit more about the back end of how the insurance markets work. So I appreciate that as somebody who has, probably six figures of insurance expenses every year.
Yeah.
And it's always been just an enigma to me. And now I feel like I understand a little bit more.
Well, and I think a lot of people, are in the same boat. And one of my clients said it. He says, people think insurance is a right, um, and insurance companies don't have to insure you, and they're not. They're in business to make money, just like everybody else. And so, if the shoe was on the other foot, what would you do?
Right.
Kind of thing. So, but hey, uh, want to ask you because as I've already declared that by day I'm an insurance broker. Wanted to shift gears here for a second and ask you some questions about some risk.
Oh,
And
absolutely.
so, as an insurance broker, I do work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be your investors, could be the weather, could be insurance, could be political. whatever it is that you consider or you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Mike Cossette, what is the biggest risk?
Well, Darren, I appreciate all your insight, and I really appreciate that question. And I like the 3 phases that you just went through, because that is going to help me restructure how I think about my own risk. That was a nice little light bulb you gave me. My personal risk, and I think a lot of investors might be seeing this now. And if they're not, if they're new investors, this is something that is vitally important, is over leveraging. I think everyone, says keep X amount of dollars, 6, 9 months of, costs, CapEx or what have you in the account. I think everyone should increase that, because as you mentioned, with the global warming and fires and hurricanes and those black swan events, everything can be going perfect, but it's what you don't and can't expect or predict that can sink the ship. And we're experiencing that now. Everything, even tough markets going fantastically, fine. And then boom, hurricane hit, no money coming in 6 months before insurance can even lift a finger. And that can sink a lot of ships. And it almost sunk ours. So, and we're still waiting to see if it will. So I think that is the biggest thing, is for so long, we've been going fast, borrowing 2.5%, interest. Why wouldn't you buy this? Cash flows, everything makes sense. And capital is available. The government's printing money. Everyone's got their hand out. People are moving fast and not stopping and assessing their portfolios the way they should be, and really setting aside the emergency funds that are necessary. I think that is, in my opinion, the biggest risk and my biggest risk.
Oh, well said. Mike, where can listeners go if they'd like to learn more or connect with you?
Every social media I've got is at Ask Mike COSS. Ask Mike Coss. Twitter, LinkedIn, YouTube, the talk ticking, and Xing, and whatever else comes out, that'll be my handle, at Ask Mike Coss.
Awesome. Well, Mike Cossette, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
I appreciate you, Darren. You run a great show, and thanks for the insurance insights.
All right, you got it. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.